Okay, so this is more tax information and financial information. My name is Carol Skillen, CPA. I know a fair bit about personal tax. I retired from CRA a few years ago, and since then I started a small business where I do people's taxes for them. So I've learned a lot about the various credits and all that sort of stuff. So first things first, though, I do have a disclaimer that I need to read. I know you're literate, but I am going to read this out loud just to be sure. So the information included in the publication is for general information purposes only, should not be used as a substitute for consultation with professional advisors. The author does not accept any responsibility or liability that might occur directly or indirectly as a consequence of the use or application of or reliance on this material. It is available with the understanding that the publisher is not engaged in rendering legal, accounting, or other professional services and is not representing any other body or organization. Okay, so having said that, I will still attempt to answer any questions that you may have at the end. So this is what we're going to look at. The whole thing, I'm hoping, will take maybe a half an hour tops, so that we'll have lots of time for questions afterward, if you indeed even have any. So this is going to look at medical expenses. Well, you guys can read. So I'm going to touch on each of these things briefly, because a lot of them you could talk for like hours on end about each topic. So medical expenses, first thing, that folio, or the folio there, and the guide, RC 4065 and the tax folio, they are very good sources of information for what is and is not a medical expense. Okay, not everything that you can think of is like, oh, but I use these support stockings for, you know, purposes. I have thrombosis or something. It's like, well, was it prescribed by a doctor? You know, so some things need to be prescribed, others are a given. Hearing aid batteries, for example, they only have one purpose, so they go in your hearing aid. There you go. So if you have any questions about whether something is a medical expense that you think it might be, or you're just not sure, go to those resources there, the RC guide and the tax folio. The RC guide is like a laundry list. So it just A to Z kind of thing. And you can go through and find the item you're looking for, and it will tell you whether it is a medical expense or not. You can claim for yourself, your spouse, your common law partner, and children under 18. And you can also claim for persons who are dependent upon you if they're over 18 years of age, like they must be dependent upon you. So an older child who has a disability that lives with you cannot live alone, that kind of idea. And it includes medical, dental services, things like that. So like the things that you normally think of. The travel one, so there are criteria with regard to travel, okay? So I will show you right there. Transportation, so it's not like catching a cab to go see your doctor. Okay, that is not a medical expense unless your doctor is more than 40 kilometers one way. All right, then you have to have some sort of transportation to get to them. So a friend of mine, unfortunately, was diagnosed with cancer. The nearest doctor he could find was down in, I think it was Brockville, and he lived in somewhere between Perth and Brockville, like in the country. So he could claim travel expenses because it was more than 40 kilometers to get to the doctor. And if it's more than 80 kilometers, then you can get accommodation, meals, and parking. If it's between 40 and 80, you only get the transportation cost by itself. So think of that. If, however, you happen to need to have an ambulance or passenger or patient transfer services, those are a medical expense, regardless of where you're going. Care and treatment. So you're caring for somebody in your family. If you take any training to learn how to care for that person, to deal with issues that they have or work with them or whatever, that could also be a medical expense. So this is something that not a lot of people realize. Construction, you can renovate your home as long as the work is being done because somebody has that severe and prolonged impairment. And it's also possible that those expenses could qualify for the home accessibility tax credit. Okay, so these are things, for example, somebody who has mobility issues, okay, and you want to put a grab bar in the bathtub or something like that for safety purposes. That is something, well, it's not really a construction renovation. Let's say you swapped it out, your regular tub, you swapped it out for one of those roll-in big showers where you can get a wheelchair in. That would be something that might qualify for a medical expense under the construction and renovation. So when you're claiming medical expenses, so when it's for yourself, your spouse, common law partner, or dependent children who are under the age of 18, you put in the total amount. Now, anybody there have a health plan? You pay for a health plan, and you get, I don't know if you can raise your little hands up or anything like that. Yeah, thank you. I can see 2 people. That works for me. So you guys, those health plans, so James and Kevin, thanks for raising your hand. Those health plans, those are obviously medical expenses. You can deduct them. And when you submit a claim, you don't get 100% back all the time. So the difference you don't get back is also a medical expense. So keep track of all those differences, add them all up, and put them in there. The downside of the medical expense is that they automatically deduct 3% of your net income as calculated when you're filling out your taxes. So depending on your net income, if you're a healthy individual, you have a couple medical expenses, you're probably not going to get anything. Combining yours, your partner, children under 18, it's still based on your income. So the higher your income is, the less you're going to get for medical expenses. Do I have the other? Sorry, I'm just looking for something. When it comes to claiming, excuse me, sorry. When it comes to claiming for other dependents, so these are people who are over the age of 18, but they are dependent upon you. You can claim medical expenses if they don't need to use them on their own return. And the good thing about that one is the medical expense, it still has that 3% reduction, but it's their income. So for example, a friend of mine, her sister lives with her. Her sister is developmentally delayed. So she can claim medical expenses on behalf of her sister because her sister is dependent upon her. And she uses the calculation based on her sister's income and not her own. So that's just a little bit of a difference between when you're claiming medical expenses for either yourself, spouse, or child under 18, as opposed to a dependent person who's over 18. So like my friend and her sister. So medical expense, attendant care is, I'll call it a unique medical expense because it can impact your disability tax credit. Does anybody out there have a disability tax credit certificate for themselves or for their partner or whatever? I can only see 2 people on my little thing here. So unfortunately, nope, nobody. Okay. So at any rate, attendant care. So this is not respite care. Okay. So if somebody comes in for an afternoon just to sit, basically watch, whomever, so that you can go off and do the groceries. That's not really attendant care. Okay, the attendant care is what it says they're doing personal tasks which the eligible person with a disability cannot do for themselves. Okay, so the tasks could include meal preparation, maid and cleaning services, and all that sort of stuff. But be careful that you're not contracting a cleaning service to clean the house, because then that's something a little bit different. Okay. It could also include providing companionship, but you need to be careful in how the invoices that come to you are worded and all that sort of stuff. Because as I said, if it's just a respite for you to get out of the house, then it's really not going to work. And what else we got here? So the eligible person with a disability is refers to a person in respect of whom a disability tax credit could be claimed. Okay, so that means that they would have to have the disability tax credit with regard to that. Let's see. Okay. And then here's how it could work. So a nursing home. So this is, think of nursing home more, that's a long-term care, okay? That 24/7 kind of care that, you know, somebody would get. It's constant care and attendance. That is a nursing home. So you can pretty much claim everything that is paid to the nursing home provider, other than like some personal things, like maybe a haircut or something like that. And those wouldn't be eligible, but pretty much everything else is: food, accommodation, nursing care, admin fees, maintenance fees, even social programming activity fees. Those can be claimed. Notice that in this case, the certification required is that form T2201. That's the disability tax credit. Okay, so it's just a lot easier to say T2201 than all that other stuff, or DTC. So in the nursing home, excuse me, if the individual has a disability tax credit or a note from a medical practitioner saying that they're there for a reason and they're not going to be leaving, then you can claim the disability amount under the disability tax credit or the nursing home fees. Now, I'll tell you right now that the disability tax credit, non-refundable tax credit, is a little under $9,000. I don't know the exact amount off the top of my head. It's a little under $9,000. If you can find a nursing home that costs less than $9,000 a year, that would be absolutely amazing. So chances are you're going to be claiming the nursing home costs, okay? Because they run, what, a couple of $1,000s a month. The next one, so that one, the first block there, the nursing home attendant care, is all included in there. So you can just claim it all. The second block there, salaries for one full-time attendant outside a self-contained domestic establishment. That just basically means you're in a retirement home, okay? Self-contained domestic establishment is a house, okay? So if you're in a retirement home and you have to have somebody come and help you with these personal tasks that you're doing, okay, in order to claim the attendant care costs, you have to have a disability tax credit, okay? Salaries and wages. So this is the salaries and wages for attendant care given in Canada. This is somebody who does not live in. They come on a daily basis. So you can claim, and again, you must have the disability tax credit. This one's a little bit unique in that you can claim the disability tax credit and up to $10,000 of these attendant care expenses as a medical expense, okay?
Sorry, I'm going to interrupt here.
Sure, go for it.
You were talking about at-home care,
Yep.
But you said it had to be in a facility. Could it not be at home as well?
And that's what this one is here, the salaries and wages for attendant care given in Canada. This is somebody who comes to your home. They don't live with you, but they come to your home to help whomever with those personal needs.
All right, thank you.
Yep. And for this particular one, you can claim if the person who is receiving the care, the attendant care, has a disability tax credit, you can claim the tax credit as a non-refundable tax credit and up to the $10,000 for the attendant care costs. So it gives you a total non-refundable tax credit of approximately $18,000. Well, it's 19. If your attendant care costs are really, really excessive, then it's a numbers game. You just have to figure out, well, where am I going to get more credit? Combine the two, or just don't even claim the disability tax credit and claim the huge amount of attendant care costs that I have over the year. So that's a choice that you have to make. Full-time attendant at home. So basically this is, think about somebody who's living in at the same address. Okay, so somebody is there constantly. In this one, either the disability tax credit or the note from medical practitioner. Okay, so either one of those two. And this one, though, you can only claim either the disability tax credit or the attendant care expense as a medical expense. You can't get both of them there. Salaries and wages for care in a group home. Okay, you can, if you must have the disability tax credit, and then you can claim attendant care expenses and the disability tax credit. And if you're in an institution or whatever, some other place, detox clinic, whatever, the disability tax credit or the note from the doctor. And again, you can claim both of them. So the attendant care is a medical expense. It gets lumped in. But the reason I highlight it out is because of the impact it has if the person has the disability tax credit certificate. It's actually just a letter, but they call it a certificate, which I will talk about right now. So disability tax credit, you have a form. So the CRA is the one that determines who is eligible based on the submission of this particular form. And there is a new form that came out just this year, as a matter of fact. And it's actually a lot more user-friendly, in my personal opinion. It's quite lengthy. It's like 16 pages long or something like that. I have a copy here. I'm not going to bother showing it to you, but it's broken out. And for your purposes, so Part A, individual section, you fill it out and, you know, give all the name, date, address, social insurance number, all that good stuff. And then also, when you apply for a disability tax credit certificate, it can be backdated, okay? So a client of mine, her daughter, she is diabetic, okay? So she's been diabetic for a number of years, but she didn't realize that she could put in a claim until the Diabetes Association sent out a notice to everybody, said, oh, you should file for the disability tax credit certificate. So she did, and what they did is they would backdate it from when her daughter was diagnosed with diabetes. So it went back 3 or 4 years from when she actually applied for this disability tax credit. And what they will do is there's a little box you can tick on page 2 or somewhere that they will adjust your previous tax returns. Okay, so it's worth ticking that off. And either the individual, if the individual is an adult who files taxes, or you can say, well, please do the parents. It's not something that's advertised a whole bunch. Certain medical associations, like I said, the Diabetes Association, they were, you know, contacting people, letting them know. And because one of the things on the disability tax credit certificate is mental functions necessary. Well, actually, first I'll say apply for it. Okay, go get the form T2201. You fill out part of it. You have to go to the doctor. So Part B is, you know, the basic activities of daily living. Okay, so you have to have a problem with speaking, hearing, walking, eliminating, feeding, dressing, mental functions necessary for everyday life, or you're on life-sustaining therapy, like you're on dialysis or something like that, okay? Those are the categories that are on the disability tax credit certificate. So you take it to your doctor and you say, look, this is the situation. I would like to have you sign off on this so I can submit it to the CRA. They will review it, and then they will send you a letter, and the letter can be either a permanent thing or it can have a time frame to it. So it'll basically say, okay, yes, you've been accepted, your disability tax credit effective this day, and it may expire this day, or it may just go on forever. Like if you're blind, you're blind, okay? Unless, you know, you get new eyeballs in your head, you're probably not going to get your sight back. So it's going to last forever. If you, I don't know, I can't think of, I think a neurological disease, okay, possibility of recovery from it. Somebody you know, their disability tax credit certificate had an expiration date. So what they would do is they would apply a year before the expiration date. So Kevin, get the form, fill it out, take it to the doctor, okay? And if you're denied, then you can appeal the denial. So the mental functions necessary for, necessary for everyday life. These are the ones that are on the disability tax credit certificate, the application. And they've added the ones in the right-hand column, concentration, perception of reality, blah, 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 those ones, and also attention. Those were added just this year, okay? And this is, to me, it makes a difference because now some of the effects of dementia, they're right there in front of you on this page, okay? If the effects are great enough that the person requires your care like daily, they cannot do things for themselves, you guys live with it, so you know what I'm talking about. Get the form, fill it out, take it to the doctor. I encourage you to try to get this disability tax credit certificate because it will, whether it's used on your spouse's tax return or on your tax return, I'm just going to do a quick calculation. It's 86.62 this year. That's right. And my calculator is a light one and I don't have the light one. It makes a difference. It will save you approximately $1,300 in tax, okay, if you can get this. Now, you can, so let's say, Kevin, it's for your spouse, okay? If your spouse does not require to use the whole of the non-refundable tax credit, that is the disability tax credit, then it can be transferred to you, so thereby reducing your taxes, okay? If, let's say my friend whose sister lives with her, her sister has a disability tax credit certificate. So if her sister doesn't use the whole thing, it can be transferred to her because my friend's sister is an eligible dependent to her. Okay, so it can be transferred over as well. So these are the new ones that were added. So attention, so showing awareness of danger and risks to personal safety and demonstrating basic impulse control. That if you can prove that this individual doesn't have this ability, then they could qualify. Concentration, being able to focus on a simple task, for any length of time and understanding and recalling information short term. This is right from the CRA website, okay? So these things, investigate it, go get it. Here are some of the resources that you would go to help you fill out the form or understand what you need to get in order to have your doctor sign off on it. So, and they're quite good. The information is getting better and better. You just need to know where to find it. So all of these, medical expense tax credit, medical expenses, I already mentioned, but for the disability tax credit, look at those particular documents and it will help you determine whether, is this person eligible? Can we get it? Yay or nay kind of idea. Okay. But I definitely urge anybody who's dealing with a loved one who has dementia to apply for a disability tax credit certificate. Okay. Okay, so moving off of medical and that sort of stuff, a few other deductions, credits that might be available. So home accessibility expenses, I mentioned that briefly. Renovations must be for the main residence of the person who is 65 years of age or older, okay, or eligible for a disability tax credit. So Kevin, let's say your wife is 63 and she does get the, I'm just kidding, okay, just making this up. So she's 63 years old and has a disability tax credit, and you required home accessibility expenses, those grab bars and stuff like that, then you could have, you could claim those as a non-refundable tax credit. Refundable medical expense supplement, that's for a low income individual, because the 3% deduction from the usual 3% deduction from medical expenses when you're figuring out your non-refundable tax credit, if your income is just a little bit too high, you're not going to get much, right? So if you have a low income, then you may be able to get a supplement. Canada's worker benefit, again, it's another low income supplement. Disability supports is if you have an impairment and you paid expenses in order to be able to work, go to school, do whatever, then you might be able to get a deduction for the expenses there. GST credit, and then eligible dependent. This is the person over 18. You supported, yeah, so you don't have a spouse. You supported a dependent in the year. They lived with you. It's a parent, grandparent, child, grandchild, brother or sister, under 18, or they have some sort of impairment. So there are additional amounts that you can get other credits. Okay, here's another one. Now, Canada Caregiver amount. This is not attendant care costs. This is for you people who are caring for somebody, okay? So you are caring for your spouse, common law partner, dependent, or other dependent who has an impairment, okay? Excuse me. And there's 5 different lines on which you claim it. It just depends on who you're claiming for, okay? So if you're claiming for your spouse, common law partner, okay, then you do a calculation and it's income tested. So as you can see, you do the calculation. So you have your basic personal amount. If you're breathing for 1 second in the year, you have to file a tax return. And if you're breathing for that 1 second, you get this basic personal amount, okay? Now, you can add to that if you're caring for somebody who is dependent upon you, then you add that $22.95. However, if your spouse's income is greater than the combined total, you're not going to get any addition. Okay, you're not going to be able to claim the spouse's common law amount. So the basically, if their income is over $16,000, don't even bother going through the calculation, okay? Because you're already over the limit. So that's when I say income tested, it means that they're going to deduct an amount before they allow you to have any of it. So that's spouse, common law partner. This is eligible dependent, which is also income tested. And again, I think the amount, yeah, basic, again, it starts out basic personal amount. You add that same amount to it, $22.95. So again, if their income, if that dependent's income is over $16,000, then you're not going to get any Canada Caregiver. However, not all is lost, because there's another line that you can claim for spouse, common law partner, or eligible dependent aged 18 or over. And this one has a higher threshold, okay? This one has the threshold. I quite honestly forget what year this is from. I think it's 2021. So it's 24,604. So we've gone from a base income threshold of 16,000. Now we've moved up to 24,000. So you tried to get it before, you couldn't because their income was too high. Now you got a second kick in the can, okay? If their income is more than 24,600, or more than 24,600, then you're not going to get anything. If it's less than 24,600, then you might get a non-refundable tax credit for the Canada Caregiver amount. Now, for all of these that I'm going through, so I've given the line item up there. So 30425. If you look at, excuse me, the T1 reference guide, I don't know the exact name of it, but just type in your favorite search engine, T1 package, and you'll get a hit to the CRA website, and then you can click on Ontario or whatever province you're in. And one of the documents is basically a reference guide to the T1. It's a booklet, and it's broken out by line item. So you can go directly to line 30425, and it will explain more about it, or whatever line you want to. Okay, so that's the spouse, common law partner, or eligible dependent aged 18 or over. and other infirm dependents age 18 or, sorry, 18 or younger. Sorry, just a sec. 18 years or older, yeah. So this is infirm dependents aged 18 or older as well. And again, it has a $24,604 threshold. So if their income is less than that, then you may be able to get a Canada Caregiver credit. And for children under 18, okay, it's a flat amount. I just threw that one in there. I don't think it applies to anybody here, but I just threw that one in there because it's the 5th one. Okay, that is the end of talking about the tax side of things. So managing your finances in retirement, good luck. That's all I can say. If you've got a pension, you're ahead of the game right there. If you've managed to save up your RSPs turned into RIFs, whatever the case may be, that's great. Question comes down to, well, what if my spouse has to go into a home and I don't? So you're maintaining your house and you're also maintaining rent at a either a long-term care facility or some other assisted living place. These are things that you don't, there's no way you can predict these things when you're going through life and trying to save for the ultimate possibilities. So what you can try to do is split income. So if one of you's on pension and the other isn't, if you can split your income between the two of you, you can minimize your taxes, so you can you can save a bit of money that way. You can share your CPP. You apply for it once. When you get your CPP, you can apply for it. You can apply for it now, even if you're taking your CPP already. You can share the CPP so the other person gets up to half of it. The pension splitting, it's up to half, but you can change it every year. The CPP thing is whatever you picked when you signed up for it. Balancing your TFSA and your RSP or RIF withdrawals is very important, because if you take, like you all know, the TFSA is tax-free savings account, and whatever I earn in there, there's no tax on it ever, which is a wonderful thing. Whereas with the RIFs, RSPs, you take it out, you pay tax. If you collapse a lot of your RSP or take out a lot of RIF money all at once, tack it on top of whatever pension or other income that you may have, you could put yourself into a tax bracket you don't want to be in. So if you balance withdrawals from your TFSA and your RSP, you can monitor what tax bracket you're going to put yourself into. Okay, so there's really not a whole lot. I mean, getting another job, I mean, that's, in some instances, that's what happens, what has to happen. The guaranteed, so you've got the OAS, there's ODSP, disability savings plans, if you're ineligible for OAS. The GIS, and the guaranteed annual income supplement benefit person, you're automatically considered if you've applied for the GIS, guaranteed income supplement, and you file your tax returns on time. Okay, so apply for these things. Make sure that they're there. If your spouse is in a long-term care center and you're not, there's also, the name of it's escaping my mind, involuntary separation form for purposes of the provincial credits and all that sort of stuff. So you can, what happens is you involuntary separation so that you each claim the personal credits, whereas generally when you file together as a couple. So income limits will impact some of the credits that you may get, but if you have an involuntary separation, then each individual is considered by themselves with whatever income they have. And then the credits, they may get a GST credit, or they may get GIS, or they may get something else that they normally wouldn't if you combined both of your incomes together in your tax returns. Trusts, depending on the value of your holdings, it's one way to protect. Okay. Generally, when you have a trust, other than a trust that is established upon death, which is a graduated rate estate trust, holds that status for 3 years, or a qualifying disability trust, those two, they pay taxes at whatever normal, shall we say, normal marginal tax rate would be based on income. Any other trust will pay taxes at the highest rate, which in Ontario is 53.53%, okay, on any income that the trust has, except for, well, actually, no, I shouldn't say that. And generally, when you put money into a trust that is not a GRE, an estate trust, when you put money, property, whatever, into a trust, you are deemed to have sold it, and you may have a tax implication. So let's say you had property, a cottage, you put it into trust for the kids to figure out what to do with later on in life. You're deemed to have sold it to the trust. You have a tax bill, most likely. Okay. An alter ego or a joint spousal common law trust is a little bit different. You can put assets into these trusts without having the tax implication hit at that time. So it goes into the trust. You are the beneficiary. If it's an alter ego trust, you're the beneficiary. If it's a joint spousal common law trust, then you and your spouse are the beneficiary. You can be the trustee yourself. You can hire somebody. Okay, it's entirely up to you. It means that whatever's in this trust, it doesn't belong to you anymore, so that when you pass away, it does not go through probate or the state administration tax as it's known now. Okay, and then you, through the trust deed, the document that sets up the trust, you specify what you want to happen to the property in the trust at that time. It's kind of like a will for the trust. Okay, so that when you pass away, the trust, obviously, you're not the beneficiary anymore. If it's an alter ego trust, you pass away, the goods have to go somewhere, the property has to go somewhere, and the trust deed will say where it all goes. There is additional paperwork because the trust must file a tax return. It's a T3 is what it's called. And there's a new form coming out. You just have to list what the holdings are in the trust and who the beneficiaries are. Not a huge amount. But yeah, there is additional paperwork. And as I said, generally the taxes are a lot higher than your own personal taxes. What some people do is they put money into the trust, but any earnings they give to the beneficiary. So the beneficiaries will pay tax at their lower rate than what the trust would pay tax at. So that is something that people do. Again, it sort of depends on the value of your own estate that you have at the time, whether it's really worth it. Because there is a cost, obviously, to setting up a trust. You're best to get somebody who knows exactly what they're doing to help you set it up. Last thing I'm going to mention is powers of attorney for finances and property. This is different than a power of attorney for personal care. They are two separate documents. They do two separate things. You can have the same person be both. That's entirely up to you. Just make sure you trust whoever it is that you're naming, because it is very, very powerful. The power of attorney, it's you. If I was your power of attorney, I could go to the bank and clean you out. Okay, so you need to trust whoever you've named as a power of attorney. There's a general power of attorney versus continuing enduring. So the general power of attorney basically it can be specific or limited. So let's say you owned property in another province that you wanted to sell, but you didn't want to run back and forth all the time to deal with it. So you would give somebody in that other province power of attorney with respect to the sale of that property only, period, end of sentence. So that is a general power of attorney, very specific. And also a general power of attorney, if you become mentally incapable of managing your own affairs, it does not exist anymore, okay? It ends. What you want to do is you want to have a continuing or enduring power of attorney, okay? And any power of attorney takes effect as soon as it's signed, unless you stipulate within it that it only comes into effect should you become mentally incapable as proven by whatever test or by whatever doctor or something. You can put that in the power of attorney, but it is generally they come into effect as soon as it's signed off. It's having the continuing power of attorney or enduring power of attorney is a good thing if, you know, things go south, because you can't sign documents once you have passed that point where you are no longer mentally capable. You legally cannot enter into agreements, documents, whatever the case may be. So having the power of attorney kind of relieves that worry. Again, just if you are going to get a power of attorney, just, you know, make sure that you trust the person that you're asking to do this, because as I said, it's a very, very, very powerful document. And that is my summary. That is the end of that. So